In a previous video, I shared my experience of selling one of my properties. As many of you might remember, I made a decent profit from that investment. But here's the surprising part. Even though I made a solid profit, I didn't have to pay any capital gains tax. In fact, I was able to claim tax deductions instead. That probably sounds unbelievable. So how exactly did I manage to do that? In today's video, we're going to look at some common mistakes people make when turning their owner-occupied home into an investment property. These mistakes could cost you tens of thousands of dollars. If you're planning to make that move, make sure to watch this video until the end. Before we start, just a quick disclaimer. Everything I share here is based on my personal experience and is not investment or tax advice. Everyone's situation is different, so please speak with a qualified accountant or tax advisor before making any decisions. Let's start with the first common mistake. When buying a new home, many people refinance their current owner-occupied property and convert it into an investment property. Most people assume that since the old home becomes an investment property, the equity they cash out from refinancing must be investment debt. But that's not how it works at all. Here's an example. Suppose you have a home worth $700,000 with an original loan of $500,000. You've paid off $300,000, so there's only $200,000 remaining. If you refinance, the bank might allow you to borrow up to 80% of the home's value, which is $560,000. After subtract the existing $200,000 loan, you can access $360,000 in equity. If you're buying a new home worth $1 million, you might use the $360,000 as the deposit and borrow $640,000 more. It seems like a smart move, but according to the ATO, your investment loan is still just $200,000, and your owner-occupied debt is now $1 million. Why? Because the ATO doesn't look at what property you use as collateral. They care about how the money is used. Even though the $360,000 came from investment property, you used it to buy a home, so it's considered owner-occupied debt and none of the interest is tax deductible. As a result, your investment loan is only $200,000, while your owner-occupied loan has reached $1 million. This goes completely against the basic principle of property investment. As investors, we should aim to minimize bad debt that is not tax deductible and increase good debt that is deductible. But in many cases, just like in this example, the outcome ends up being the exact opposite. So, is there a better approach? Actually, yes. A good home is not always a good investment property. If after evaluation the property is not suitable to be converted into an investment, selling it might be the better choice. Let's go back to the previous example. If you sold the property, you could cash out $500,000 in equity. With that $500,000 in hand, you could buy a new home worth $1 million and only need to borrow another $500,000. From this new home, the amount you could cash out would be $300,000. As we mentioned earlier, the ATO looks at the purpose of the loan. If that $300,000 is used to purchase an investment property, then it becomes deductible debt. For instance, if you buy an investment property worth $700,000, you only need to take out another $400,000 loan. In this case, you still end up with a $1 million home and a $700,000 investment property. But now the investment loan is $700,000, while the owner-occupied loan is only $500,000. In other words, your good debt is maximized and your bad debt is minimized. Of course, this method is not always suitable for everyone because buying and selling property involves about 5% in transaction costs. You need to calculate whether the tax benefits you gain can cover these opportunity costs. Generally speaking, if you plan to hold the investment property for the long term, this method can save you a lot of tax. The second common mistake many people make is making extra repayments. In order to pay off the loan faster, many people put in large additional repayments, but this unexpectedly reduces their flexibility in the future. For example, let's go back to the same case. Suppose out of the $300,000 you repaid, $100,000 were extra repayments. In the end, your investment loan would only be $200,000, while your home loan would be $1 million. This structure is not reasonable. If you had not put that $100,000 directly into the loan, but had placed it in an offset account instead, the situation would be different. You could still save the same amount of interest, but when you change homes or upgrade, you could take that $100,000 out and use it as a deposit. With this approach, the final result is that your investment loan could increase to $300,000, while your home loan would be reduced to $900,000. Compared with the previous setup, you would have more deductible debt, and your tax structure would be healthier. Another thing many people easily overlook is failing to get a CGT valuation when turning their home into an investment property. For those who are not very familiar with CGT, let me give you a quick explanation. CGT stands for capital gains tax. It is calculated by taking the selling price of the property and subtracting the cost base. If the result is positive, it means you have a capital gain. If it is negative, it means a capital loss. The cost base usually includes the purchase price plus related transaction costs. To keep things simple, let's just treat it here as the purchase cost of the property. One thing to note is that selling your own home does not require you to pay CGT. But once you turn your home into an investment property, the ATO will reset the cost base at that point. If you do a CGT valuation, the market value at the time of conversion can be used as the new cost base. If you don't, the ATO will use the original purchase price as the cost base. For those of you who watched my earlier video about investment property returns, you may remember that in 2020, I bought a property for $465,000. In 2022, I turned it into an investment property and got a CGT valuation, which came in at $655,000. Finally, in 2024, I sold it for $620,000. If I had not done the valuation, the ATO would have treated my cost base as $465,000, which means the capital gain would be $155,000. Since holding for more than a year qualifies for a 50% discount, $77,500 would be included in taxable income. At a marginal tax rate of 30%, I would have had to pay around $23,000 in tax. But because I did the valuation, the ATO recognized my cost base as $655,000 instead of $465,000. This meant that, from a tax perspective, the property was sold at a loss. So not only did I not have to pay tax, I also had a capital loss that could offset future investment gains. That's why, if property prices have gone up when you turn your home into an investment, never forget to get a CGT valuation. It can often save you tens of thousands in tax. The last common mistake people make is failing to get a depreciation report when converting a home into an investment property. A depreciation report allows you to spread the cost of construction, renovations, and fixed assets over future years, treating them as depreciation expenses that can be deducted against rental income. For newer homes or those with a relatively young building age, this number can be significant. A depreciation report might allow you to deduct thousands or even over $10,000 a year, directly reducing your taxable income. So, when you're considering turning your home into an investment property, always plan ahead. It's best to consult with your accountant and your mortgage broker. Different structures can lead to completely different tax outcomes and cash flow performance. As an experienced mortgage broker, I often help clients organize their loan structures. If you need help with loan planning or finance, feel free to reach out to me. I can design a more suitable plan based on your situation. If you found this video helpful, make sure to give it a thumbs up and don't forget to subscribe to my channel. You can also leave a comment below, sharing the pitfalls you've encountered in property investing or the questions you care about most. I'll pick some of them to discuss in future videos.